Everyone seems to think the dividend snowball effect is amazing. Video after video, they keep showing you exponential charts like these to prove what a great investing strategy it is. But they often gloss over how ridiculously long it takes to pull this off as if it's no big deal. I don't know about you guys, but 30 years is a freaking long time to be waiting around to spend my dividends. Some genius on the internet even thought up a 40-year chart, since I suppose people live longer these days and we can't have them spending their dividends while they're still alive. While the dividend snowball may work for the few people who are really patient and disciplined, chances are that if you're watching this, you might feel the same way I do, that there must be a way to live off dividends faster than this. I imagine for many people, they are attracted to dividends primarily because it's the ultimate passive income source. It's as passive as it gets. Once you buy a dividend-paying stock, you don't need to do anything more as you watch money flow into your account. Unlike other passive income ideas like rental properties or online businesses, where they can take a lot of time and effort, dividend stocks can be your path to true financial freedom so you can focus on enjoying life. However, nobody wants to wait decades to make this a reality. So in this video, I'm going to share how you can live off dividends much earlier compared to the dividend snowball. Let's start with the dividend yield. You need a high dividend yield to live off dividends sooner, but the dividend snowball doesn't focus on this. People who like the strategy prioritize high dividend growth rates and a long dividend history. They argue a high yield is a sign that a company is risky and may not continue to pay the dividend. On the other hand, a long dividend history indicates a company is committed to paying their dividend, and a high growth rate indicates a company's business model is sustainable. Procter & Gamble is a prime example of this. At its current price, it pays a 2.7% dividend. It has been paying it out continuously for 65 years, and it's grown it by just under 6% the most recent 5 years. And if you look further back, it has grown its dividend continuously over the most recent decades. However, take a look at the yield on cost. You would have had to wait 10 years to earn a 5% yield, and then wait another 10 years to break above 8%. Instead, if you had bought shares of Realty Income, a popular high dividend stock, you would immediately start earning close to a 5% yield right now, and it would only take you 9 years to earn an 8% yield based on yield on cost. Now, I'm simplifying things here, but say you need $50,000 in dividend income to live financially free. At an 8% yield, you would need $625,000 invested in Procter & Gamble for 20 years to pull it off. But with Realty Income, you only need to wait 9 years. Increasing the dividend yield of your portfolio will dramatically cut the time it takes to live off your dividends, and it should be your highest priority. But the question you may ask is, are high-yield stocks safe and reliable? And there are certainly critics who refer to this as yield chasing and think it's a bad idea. One of the biggest concerns they raise is that high dividend payouts are unsustainable for many companies, and there is a good chance that the dividend will be cut sooner or later. While I agree there are poorly managed ones out there at risk of cutting their dividends, this overgeneralizes what a high yield indicates about others. For example, there are special types of companies that are legally required to pay out high dividends, such as REITs like Realty Income. REITs are required to pay out 90% of their income to their shareholders annually in order to maintain their special tax status as a REIT. So their dividend yields tend to be much higher than normal companies. This is also true of master limited partnerships, which are typically in the energy pipeline industry, and business development companies or BDCs. And just like any sector or industry, there are good and bad companies, but for these special types, you can't make that judgment based on the yield alone. Another objection that is raised when it comes to high dividend stocks is that they typically pay ordinary dividends rather than qualified dividends. With qualified dividends, you pay taxes at these lower capital gains rates, while for ordinary dividends, you supposedly pay these higher income rates, and so people automatically assume qualified dividends are better. This is false. It's a naive understanding of how dividends are taxed. In this video here, I debunk this common tax myth that everyone seems to fall for. But the biggest concern people have with high dividend stocks is that they often don't grow their dividends very much. And with inflation at record levels these days, they would argue that the dividend income from high-yielding stocks will over time buy you less and less. What people don't realize though is nowadays there are ways to earn safe and reliable dividends that keep up with inflation and are not dependent on the profitability of any company. If you're willing to invest in ETFs, over the last 2 decades, there's been a growing category of ETFs that focus on generating high dividend income called buy, write, or covered call ETFs. Some of the more popular ones can pay out dividend yields higher than 5%, and as much as 16%, which I'll introduce in a moment. They're able to generate these very high yields by using options trading to earn a recurring fee called premiums. These premiums are then paid out to the ETF holders as dividends, along with any regular dividends received from the basket of stocks. If you want to learn more about how options works to generate income, you can check out this video and fast forward to around 11.5 minutes where I explain it in plain English. The key detail you need to know is that these premiums, the source of the high dividends, are basically like trading fees people pay the ETF. They aren't dependent on the ability of any company to pay this dividend. They're money earned through a business transaction, and this means they keep up with inflation just like any product or service. Although these ETFs don't have a long history, they have grown rapidly in popularity for income-seeking investors, with 32 pure-play covered call ETFs on the market today. Within this category, however, are funds that take an active approach to reduce the downside risk that is unavoidable with a pure covered call approach. One of these that I'm keeping an eye on is JPXQ, the JP Morgan Nasdaq Equity Premium Income ETF. This is a recently launched ETF that seeks to provide current income while maintaining prospects for capital appreciation. This is a variant of JEPI, a fund I've covered in detail about before, but JEPQ focuses on the Nasdaq 100 index, whereas JEPI focuses on the S&P 500. By focusing on the Nasdaq, this fund is on track to generate a dividend yield of around 16 to 17% within its first year. This is because the Nasdaq is generally more volatile than the S&P 500, and more volatility means higher option premiums. These ETFs are amazing for the high dividend income you can get, but the big downside is that they don't offer much capital appreciation. Covered call options by their nature cap the upside of any stock position. For example, this is the price performance of JEPIX, a mutual fund version of JEPI. Between this, JEPI and JEPQ, this has the longest history, and you can see that it's been pretty flat, which isn't a surprise. The solution to getting capital appreciation here is to simply add a growth ETF into the mix and allocate them based on how much income and appreciation you are looking for. If we do add capital appreciation, we want to benchmark this to a dividend snowball strategy to compare it to something. The simplest way to do this is with an ETF like SCHD. People who are into dividend growth investing absolutely love this fund. This is the result we get if we match it up against JEPIX in Portfolio Visualizer. In this scenario, we made an initial investment of $10,000 with no additional contributions and with no dividend reinvestment. JEPIX didn't grow at all, but it did offer some generous dividend income. If you're willing to sacrifice some dividend income for more capital appreciation, we can add a popular growth ETF like QQQ, the Nasdaq 100 ETF, into our portfolio. If we allocate them 50-50, then this is what we get. Our performance now more closely matches SCHD, still a little bit short in terms of capital appreciation, but if you look at the dividend income, it's generated about $600 to $700 in the last 3 years for a $10,000 investment, a much higher income than SCHD. Now, this is a really simple portfolio example, but if you want to learn more about how to build a dividend portfolio properly, in this video here, I go into much greater detail and highlight some of the really important tips that you may not hear anywhere else. So consider checking it out. Thanks for watching.